So it just goes
Wow.
to show you, yeah, if you just wait, rent it out or come up with some alternative exit strategy, then typically you're going to get your money back. You just have to time it out right?
Hello and welcome to the Total Wealth Academy video podcast. I'm your host, Steve Davis. The Total Wealth Academy video podcast is designed to help you improve your financial IQ. What I try to do is bring people to you who are in the business and who you should be doing business with if you're going to be a professional real estate investor. You'll see everything from syndicators to mortgage lenders like we've got today. But be aware that all of these people are actually real estate investors as well. And if you're going to be a real estate investor, it's important that your team be made up of real estate investors. It's like my CPA, who is also a passive investor. He knows what he's doing. You want to keep that, you want to build that type of team for yourself. And I hope this podcast helps you do that. My guest today is Daryl Dyke of Noble Mortgage. Daryl is a competent real estate investor, but he's also helped hundreds of our members buy real estate for as little as zero down. And we'll discuss that and how that works later in the podcast. But Daryl, welcome to the show. Thanks a lot for coming on.
Absolutely. Thanks for having me, Steve. Good to see you as always.
Good to see you. You just came back from Cancun?
I did. I went there for a short little trip over New Year's and got a little sun and a little relaxation.
Nice. Was it for a wedding or just the holidays or?
Now, just the holiday, just wanted to get out of town and do a little reset and relax before we're kicking off the new year. So it was nice, just like a 3-day trip.
Well, you look good and refreshed. So
Thank
let's
you.
start off with tell them a little bit about your real estate investing portfolio and what you've done over the years as far as an investor.
Yeah, I've owned, a lot of single family houses. I was thinking about it as you were talking, Steve, and the very first two houses I bought, I was a loan officer at a hard money company when I just started off my career, and I got a call from a guy that owned a couple houses in Houston, and he wanted a loan to pay property taxes, and so I was trying to do a loan for this guy, and he owed. I'm not kidding you, Steve. It was like 20 years of back property taxes.
Oh my God.
And I was like, I can't believe they haven't foreclosed on this guy. And the houses were in bad shape. And I just could not, even in a hard money basis, I could not get this guy a loan. The lender I worked for wouldn't give it to him. So I was like, huh. I said, well, maybe I'll, buy these houses from you. So I started talking to him and he ended up selling me these two houses over off of I-10 in Spring Branch area. And so that was my first actual real estate transaction from an investment property standpoint. So I bought these two houses and cleaned them up and held on to them for several years as rental properties and then eventually sold them. And that's kind of been my motto. I'm not really someone who flips houses because it's more of a job, and I've got a full-time job already. So, when I come across property that I think probably has good long-term appreciation to it, I buy it, fix it up, rent it, for a period of time. And then when I think the market is a good time to sell the property, I've typically sold those properties and moved on. So that's what I did with those two houses. I've owned a couple fourplexes in the Montrose area, held on for also several years, 4, 5, 6 years. At one point, I had about 20 rental houses that I was holding on to that I acquired when the market was really down during '08 and '09 and held on to them, most of them to about 2017 or so. Then I sold a bulk of them. And I had two more that I held on to, I think till probably 2019. And those last two I had were actually foreclosures that I foreclosed on in 2008. And it's interesting because, I always say, if you can't get the price that you want for your house, just wait, just wait.
Yeah.
The market will turn. So those two last ones I sold, I remember I had a $50,000 loan on each one. And when the market crashed, I couldn't give them away for $30,000.
Yeah.
And so I was like, I'm not taking this loss. So I just rented them out. And they actually were good rentals. I held them for over 10 years. And when I sold them, I think it was 2019, I ended up selling them for about $130,000 each. So it just goes
Wow.
to show you, yeah, if you just wait, rent it out or come up with some alternative exit strategy, then typically you're going to get your money back. You just have to time it out right?
Yeah, that's the only time people get in trouble is when they're forced to sell in a down market. And that's
Yep.
just, you've got to make some big mistakes to be put in that position. Um, I bought a ton of property in 2008, 9, 10, 11, 12. You helped me do that.
Uh-huh.
Um, and all of those deals I sold in 19 and 20. Boy, don't you wish we'd waited till 21?
That's what I was always. Every house I sold, I can tell you, almost every house I sold, I wish I hadn't have sold it.
Yeah, that is a truism for all real estate investors. With the wisdom of hindsight, I look back at everything, apartments, single family. Man, I wish I still had them.
Yeah. I mean,
Crazy.
it really is true. You know, even my first house that I bought to live in, it was in the Heights, in Woodland Heights, which was the best area in the Heights. And I bought it for $130,000 in the late 90s.
A
And I
house
paid
in the Heights for $130,000.
$130,000, you know, and it was a little two bedroom, one bath bungalow. I just got married and, you know, had a child. And, you know, eventually I was going to buy a bigger house in the Heights. And I remember thinking at the time, you know, I should keep this house. But I was so young, I needed money to buy the next house.
Yeah,
You know, so I ended up doing well on it. I mean, I paid 130. I think I put 20 into it and I sold it for like 220. So, you know, I did make money on it. But now every once in a while I drive by that house and that house is worth, I don't know, 550, $600,000. And they haven't even renovated it that much. You know, it's pretty much in the same condition, maybe a little bit of interior things, but the exterior is exactly the same. They haven't expanded on it or anything. And I'm like, man, I should have kept that house.
yeah. It's but like you said, you needed the money to get the next one.
Yep.
So have you done any multifamily, commercial, or RV parks, and anything outside of single family?
No, I've always been in single family. Like I said, I've done some fourplexes that I've held on to for a while. I did have a single family house that I owned for a long time in Spring that I ended up selling as a commercial property, but it was a single family. But you know, you one thing I've learned in real estate is you have to think creatively. And so the house that I owned in Spring, you know, had a good sized lot and it was unrestricted. And at the time, I had it listed as a single family on HAR. And I just wasn't getting a lot of bites. And I was like, you know what? I'm going to put this property on LoopNet. Put it on LoopNet and put it as a like a commercial property. Be good for, you know, somebody who has a business. They can park their trucks there. That's unrestricted. And sure enough, that's how I sold that house. You know, it was
Wow.
somebody that wanted to, I think it was a plumbing company and they needed a place for their trucks and they wanted to like also have a small office. And so sometimes you have to think outside the box and think creatively what the highest and best use of the property is in order to get it sold or moved on, you know?
Yeah, that's a really good idea. Congratulations on that.
Thank you.
Okay, next thing I want to talk to the viewers about is a thing called a hard money loan, and you specialize in that. You created a mortgage company to work with investors. You are an investor, so you know exactly what they need, what they want. But if you would, let's just go over. Let me do an example. The little property over on West Green that you financed for me, I think the ARV was around 220. I picked it up for 110. I had about 45,000 in rehab. Um, that deal was using your hard money loan was $20,000 out of pocket. That was it. That was everything. Total out of pocket, $20,000. If I had used a conventional loan, that deal would have been $67,000 total out of pocket. But using your hard money loan, I got it for just $20,000. And then if you'll remember, some of the deals you got me were $6,000 down, $7,000 down. It was crazy back in 2008, 9, 10,
Yeah.
11, 12, obviously. So if you would, explain the hard money loan and how you help people get in with the lowest down payment.
Sure. So the hard money loan is a great way for investors to pick up property based on leverage, you know, because typically when you're buying a property that needs to be renovated, you're getting it cheaper than, you know, you could if it was fully renovated. So what we do is we look at the house, we look at what kind of repairs you're doing, and we send an appraiser out there to tell us what is this house going to be worth after the repairs are done. So if you're buying, always give a simple example, you know, if you're buying a house for $50,000 and it needs $20,000 in repairs, and we send an appraiser out there and they says, well, if they do all these repairs and they do it correctly, it should appraise for around $100,000. So if you're going to keep the house, we'll end up to 75% of what we call the after repaired value. So we have our appraisal for 100,000, we'll end up to 75%, which is for you non-math people is $75,000. So that gives you 50,000 for the purchase, 20,000 for the rehab, and it even gives you $5,000 for closing costs. So that's how you're able to leverage. And in that loan, it is a higher cost loan. And a lot of people, the cost of the hard money loans scare them, but it's a short-term play and it's a leverage play. So like you said, you would have had to bring $67,000 on your transaction, but you got in for 20, but you're in and out of that deal in probably 60 days, something like that.
Yeah.
As I recall, the way you would do yours is you wouldn't even take a draw. You would do all the work up front and you're like, okay, the deal's, the property's done. We'd send you the money. We immediately refinance it for you into a long-term loan. So, when you look at the cash on cash return on something like that, when you're putting zero down or, just $20,000 down, the cash on cash return goes through the roof really quickly because you're leveraging yourself based on your credit and your ability to get refinanced out of it.
Yeah, my cash on cash rate of return on that deal was 24%.
Yeah. I mean,
24%.
yeah, that's
That's
great, and I think anybody would take that deal.
yeah, it was phenomenal. And the rents went up the longer the recession lasted. It was
Yes.
unbelievable. I remember going, "Ooh, the rents are going to drop. The rents are going to drop." No, the rents went up during the recession. It was phenomenal, and I guess that's how it happens in every recession. Um, the interest rate, yeah, that is one thing that does scare people. You say, "Okay, it's 12% interest," but again, just like Daryl noted, make sure that you listen to me very carefully. Why do I not care about paying 12% interest? Because I only use it for 2 months and it kept my down payment to a third of what I would have had to have put down if I'd have used a conventional loan. So I pay 12% interest for 2 months or 3 months, but then I'm moving into a conventional loan or a DSCR loan or whatever um, with a more normal interest rate, whatever the market interest rate is. So, and that's my permanent financing. Then I lease it out and hold it. And that keeps your down payment as low as possible. Think about it. I was able to buy six and a half houses. They're about I'm sorry, three and a half houses. Sorry. Three and a half houses with that $67,000 compared to just buying one. So my cash on cash rate of return was way more than triple what it would have been if I had used that $67,000 on just one deal. I think I've done the estimate. I would have had about a 9% rate of return if I'd have put the $67,000 down, and I got a 24% rate of return by putting just the $20,000 down.
Yeah, and
And
sometimes people have limited capital. We had a client same time frame that you were buying houses, and he only had, I think he had about $50,000 that he was allocating towards his real estate investments, and he was able to pick up 8 houses with $50,000.
wow,
So it
yeah,
just
that's
comes down to how
phenomenal.
how cheap you can buy the houses. Now, granted, 2008, 2009, you could pick up houses for a song, but we still see 100% financing deals pretty often.
Yeah, I think I've seen about since April of last year, which when I started paying attention, I saw 20 or 30 zero down deals. In fact, I think one time I called you and you go, "Yeah, I'm sitting here with two zero down deals on my desk right now."
Yeah.
That you can't run a business off of zero down. I don't want the viewers to be go, "Ooh, I'm going to do all my deals zero down." That's improbable. But you need to be aware that those do occur, and you need to have the skill by working with somebody like Daryl to be able to do that and get that low down payment or no down payment. You also do conventional loans, DSCR loans. If you would, explain the DSCR loan.
So the DSCR loans are great. They're pretty much the new subprime. We had the subprime loans back before '08 and '09, and so typical Wall Street, they just repackage it and call it something else.
Yeah,
So the DSCR loans, but the DSCR, the difference is the loans now is they're built for investors. These are not someone buying a house that's their
owner
living.
occupant.
Yeah, and the terms are a little bit more stricter to get into, but they're great loans. So you typically need to have about a 660 credit score, But instead of qualifying your income, your personal income against all of your debts, what they do is they look at how much that house would rent for. And as long as the market rent in that area is, equal to or more than what your new mortgage would be, your payments with taxes and insurance and everything else, that's what they use to qualify the income of the property. And so it enables investors, because a lot of times investors, their tax returns don't show that they have a lot of incomes because they have so many deductions based on their real estate portfolios. So it's a great way for investors to build a rental portfolio without having to go through all the process of submitting tax returns. They don't ask for tax returns at all. They do want to see some bank statements to make sure you have some money in the bank and so forth. But it's a very seamless loan. And, when they first came back out several years ago, 5, 6 years ago, they were adjustable rates, they had prepayment penalties, but that market has gotten so competitive that all that's gone out the door. So now we're getting 30-year fixed mortgages. The rate is still a little bit higher than a conventional loan, but they're real competitive. I mean, they're not much higher. At one point, when the rates were higher on the conventional side, we were getting lower rates on the DSCR loans than we could on a conventional. Right
Wow.
now, they're pretty similar. They're about the same as a conventional for investment property. So it's a great loan. 30-year fixed. The rates are somewhere in the low sevens right now. Easy to qualify for. As long as your rent covers the amount of the mortgage with tax and insurance, and you qualify.
So, okay. So, and there's really no limit to the number of them that you can have. Did you just say that? You can have
There's
as
no
many DS.
limit. There's no limit across the board, but each lender typically has a limit.
Gotcha.
It depends on the lender. One lender might have 10, might be 15, but there's so many DSCR lenders out there that there's no shortage that we couldn't find another lender. If you had already 10 with one, there's another lender that would be happy to do several more with you. Otherwise, unlike the conventional side where you can only have 10 residential properties financed.
Yeah. And that's the Fannie Mae loan.
Yes,
We
that's a
better
Fannie
address
loan.
that because I'm going to get an email about this because people are fearful that they can only buy 10 houses. That's just the Fannie Mae rule. Then once you get 10 Fannie Mae loans, then you can switch to DSCR loans. Um, Explain why the Fannie Mae loan is the preferred loan.
Well, they've typically just been a lower rate. It's really been an interest rate thing. So the Fannie Mae loans, which is a conventional mortgage, I always call them the gold standard because they typically have the lowest interest rates. Again, it's a 30-year fixed mortgage. And so it's a solid loan, set it and forget it type of deal. But they changed the rule after '08 and '09. So now you can only have, it's not just 10 Fannie Mae loans, Steve. It's actually, if you have 10 residential homes that have financing on them, then you can no longer get a Fannie Mae conventional loan. So even if you have a DSCR loan, that counts as one of your 10.
Oh,
So
wow.
we always say get your 10 Fannie Mae loans first, if you qualify for that. If not, you go to DSCR. And then after your 10 Fannie Mae's, then we start looking at DSCR loans because typically they are a little bit higher rate. Not much right now, but typically maybe a little bit, quarter of a point, something like that.
Yeah, when I was picking them up, I don't know if you remember this, but do you remember when I ended up with 11 uh, Fannie Mae loans?
Yes.
And then I got this phone call, and this guy was irate. You've got 11 Fannie Mae loans. You've got to pay one of these off immediately, or we're going to sue you, and come after you. And I was like, okay. And I called you, and you just refinanced it into whatever other type of loan it would work with.
Yeah.
Um, but yeah, they are serious about that. It's
Yeah.
10 max. It's
Yeah,
10 max.
10 finance single family properties. And yeah, I don't know how that one slipped through. And somehow, I guess I bet it came down to they couldn't sell the loan because they realized you had 10 or more than 10. So they're like, we got to get one off the book so we can sell this new loan we did.
That's how they caught me, in other words.
Yeah, they probably went to sell it to their secondary investor and they're like, wait a minute, this guy has 11 loans. And they were like, oh no, we need to get one of his other ones off the books.
Yeah, I think how I got the 11th was I bought two at the same time. The last Fannie Mae purchase was two at the same time, so they didn't notice each other. They
Yes.
just both thought they were number 10.
Yes.
But boy, I got that phone call within a very short period of time,
Yeah, when they can't sell their loans, they freak out.
for sure. Okay, how do people get in touch with you if they want to learn more about the hard money loan?
Sure, they can go to our website, which is noblemortgage.com. They can also just call us at 713-680-8100, and we'll be happy to help them out.
That's noblemortgage.com,
Yes.
noblemortgage.com. Daryl Dyke, but anybody there can help you. He's got a really well-trained staff. I don't think you and I really dealt with each other when I was buying all those houses. It was always Chris.
Yeah. Chris is still here.
Yeah, he's got a hellacious team of people. They all know what they're doing. They all know what to do for real estate investors. So if you're a single family real estate investor, please reach out to Daryl at noblemortgage.com. All right, that's all I needed, Daryl. I sure appreciate you coming on the podcast today.
Absolutely. Thanks for having me, Steve.
All right, you take care.
All right. Bye bye.
Bye bye.